Hi, everyone, and welcome. I'm Leslie Jouflas. My website is tradingliveonline.com. My email is right here. I want to make sure that you know how to get in touch with me if you have questions or comments after the presentation today. And I would like to thank the presenters for inviting me back. These are always a lot of fun to do. So I've got two books out. One is Trade What You See, How to Profit from Pattern Recognition. I wrote this with Larry Pesavento. Some of you may know him. He's been in and around the markets for many, many, many years. And he's really the one that brought us Fibonacci ratios with these specific patterns. I'm going to be showing you some of these patterns today. But our topic is going to be identifying range trading versus trend trading. So we're going to go through a lot of what I hope are interesting charts and you learn a lot from this. But this book is available in 5 languages. So this is your opportunity. If you ever wanted to learn a second language, you can buy 2 books, one in your main language and one in another language that you always wanted to learn. Essentials of Trading is a book that unfortunately is no longer in print, but I do offer it as a PDF with most of the courses from my website. Okay, let's get right into the material now. So, when I trade, I want to find things that are repetitive and stand the test of time. So we're going to start with looking at a chart, looking back 100 years, and we're going to look at expansion and contraction phases, uptrends and downtrends, the definition of those, and we're going to look at classic technical analysis patterns that we can use in both contraction and expansion phases and AB equals CD patterns and other patterns that are in ranges and trends. And then we're going to look at some current charts that are set up either in ranges or trends now. This chart is from the book, The Stock Market Barometer. I have this in my collection from 1922, written by W.P. Hamilton. And this is what the market did 100 years ago. It went up, it went down, and it went sideways. This chart is of US Steel. The symbol is X, still trading in the markets today. And as I mentioned, I like to trade setups that I know are repetitive and that I can create a profitable trading plan with. And I use a process that I can evaluate, and I know exactly how I made money or lost money in a given period of time. I want to really stress that one trade is never important unless it was a huge error. Then you have to pay attention to what caused that error and steps you can take to eliminate it. Emotions are part of trading. I don't believe personally that we can take emotions out of trading, but I do believe by learning a process in a certain way, we can learn to identify what emotions are coming into our trading that are helping us and emotions that are hindering us. And once we have that awareness, then we can take steps to manage those emotions. And we're human after all. So we can't just put ourselves on autopilot all the time. And so that's why we have, I have master yourself and master your trade. So I work with students to fine tune their first to develop a trading process and then fine tune it down so they can see how emotions are working for them or against them. So when we trade, we also have to have the process. We need to have some sort of a trade plan. Random trading is like a 4-letter word. It's poison. It's not going to have a positive outcome over time. So back to our subject here. We want to study these 3 phases, the up, the down, and the sideways, because these are what determine the market environment that we're in, that then determine the trading tactics that we can apply based on our trade plan, our process to the markets. So the chart we just looked at, the 100-year-old chart of US Steel, here it is. current. This was actually from a couple months ago. It did break out to the upside. It's had a nice run to the upside. And you can see it's almost identical to the chart we just looked at. Let me go back. Let me see if I can. Well, I'm not good at the buttons going back. So, but it's almost identical where we have down moves, up moves, down moves. We've got sideways, range moves, expansion moves. So this is important to understand these three things, up, down, and sideways. So you can build your approach and a trading plan based on this simplicity. Again, it tells us the type of market environment, and that determines our trading tactics, range trading versus trend trading. And with some practice and experience, you're going to learn to spot the early signs that the environment may be shifting from one to another. I'm going to show you a current chart of the S&P 500 where we can study that a little further. And the really great part of this is that most of the patterns that I'm going to show you today can be traded in either environment. We're going to look at the classic AB equals CD, the Gartley pattern, which is a retracement testing pattern, butterfly pattern. Those all have the ABCD in them. Classic patterns, triangles, rectangles, head and shoulders, bull flags and bear flags, those really should only be traded, in my opinion, in the trends because of the nature of trends and the nature of that particular pattern. But we'll look at those on a chart in just a bit. Okay, so the markets are either in a phase of contracting or expanding. The left side of this chart shows us the contracting phase, and the right side of the chart shows us the expansion phase. So think of this contracting phase as a coil, and the coils are sort of storing energy. And eventually, that energy is going to come out of the range or the coil, so to speak. So, this is why it's very important to be able to recognize the trading environment that you're in. This is going to help you to be able to shift tactics from range trading to trend trading. The expansion phases, those can have catalysts. Usually the nightly news is going to put some sort of catalyst onto, why price did what it did, but usually price does what it does because that's what it does. But people like to put labels on why it does it. And sometimes it just seems, I swear they make it up. It's like there's more dandelions growing in North Dakota this year, and so the market moved up. I mean, sometimes it makes no sense at all. But we do have a FOMC meeting coming up, I believe, next week, and those can often be catalyst uh, to expansion in the markets. So the contraction phases usually more time is spent in the contracting or the range phases than in the expansion phases. The expansion phases can travel further with price, but usually with less time. So the the ranges are going to go through a narrowing process usually, and I'm going to show you some examples of charts on this. They may start out a little bit volatile, but they'll narrow down to usually a narrowing of range. And again, in the contracting phase, we'll see these types of patterns, A, B, C, D, Gartley butterfly, triangles. It's a testing process. And eventually, it's going to be followed by the expansion phase. So this is important to remember. And that can be the start of a new trend. And so this is what I like to think of this. This is where trends are born. They're born out of these coiling phases. The expansion phases that follow the contraction phases, they can be short-lived or they can be long-term trends. They can even be different trends on separate time frames. You may have a long-term uptrend like we have now in the indexes, but on some shorter time frames, there might be short-lived downtrends within that. The expansion phases can be very powerful. They can also fail. You can also get a big expansion move and all of a sudden it turns on a dime. The uptrend we're going to define as the price is making higher highs and higher lows. downtrends, lower highs, lower lows. And the downtrends, you're usually going to see more volatility where your ranges are larger. Remember back in the end of February and March of 2020, we were seeing, 80 point, 100 point, 150 point range days in the S&P 500, 7, 800, 900 point days in the Dow Jones. The expansion phases are going to see continuation patterns. Sometimes they just sort of need to take a rest in that trend. And so these patterns form. And usually eventually the expansion phase is going to be followed by a contraction phase. These continuation patterns, however, in the expansion phases can also be thought of as contraction phases. And both of these are fractal, meaning that we're going to see this same process on all time frames. Momentum is going to start on the smallest time frames and work its way out to the larger time frames. I'll get to a little bit more of that in just a minute. But here's just an example of an uptrend, higher highs, higher lows. Downtrend, we have lower highs, lower lows. So as I mentioned, momentum is going to start and be seen first on the smallest time frames and then work its way out to larger time frames. Now, it depends on the size of the ripple, so to speak, maybe the catalyst. But both range and trend environments will have a ripple effect. Sometimes you'll see a trend only on an intraday time frame. And that's going to be very short lived. And it may not be ready to expand out to some of those long time frames yet, but there are clues and footprints within that type of price behavior that you can learn to analyze and spot, and sort of helps you to plan for the next moves that may be coming. And um, the longer the time frames, they may show larger ripples by the news or the economic conditions that are around. So if you have a, pool of water, you drop a small rock into it, you're going to get small ripples. They're not going to expand very far. You put a big rock or object in it, and then they're going to expand. So think of that as your time frames. And remember that that ripple does not always go out to those larger time frames just because you see them on the smaller time frames. So here's the type of patterns that we can see in ranges and trends. And they also, all of these patterns may be an ABCD, or these different types of patterns may contain an ABCD. So triangles and other coiling types of formations like wedges, pennants, uh, different coiling type patterns like that. I'm going to show you what a dynamite triangle is in just a minute, but you really should learn this one. Rectangles, which I refer to as a money box, is a basic, you have a horizontal trend line upper and lower. It's a rectangle shape. I call it a money box because eventually it's going to come out of that box and you pull money out of the box if you're trading the correct direction. And the bull and bear flags, head and shoulder, inverse head and shoulder, and these always have a B, C, D in them. Then retracement patterns, Gartley's butterfly pattern, 3 drives, and then Fibonacci retracements. But again, most of these show up in ranges and trends. So knowing which environment you're in is going to dictate how it's traded. So here's a chart that illustrates these patterns. So we see a lot of patterns in this. So let's start. I didn't draw them all in. It just would have been incredibly cluttered. So here we have, starting over here on the left, this is a B, C, D buy pattern, retracement up. That's tradable. Here's a B, C, D sell pattern, retracement down. That's tradable. And within that formation, we have an A, B, C, D buy pattern, tradable. This is called a butterfly sell, which has an A, B, C, and a D, and it extends beyond the most recent higher low swing. And that reverses all the way down the lower part. Here we have an inverse head and shoulder pattern and back up. and so on and so on. Here's a head and shoulder pattern coming back down the bottom. Here's a triangle, but these are all within a range. And so that's what's important to recognize. Now, the center of the coils are very important areas to identify. And one way that you can kind of spot that you're in a range trading environment, that you're coming back into some type of contraction phase after expansion, is that you start to get these moves that are, they sharply move down and then they reverse back up, and the up move reverses back down. So you get these sharp moves up and down, and then you can start to say, well, we might be coming back into a range, and then you can sort of start mapping out where you see the perimeters of the range, and that might change with time. But I do try and like to find the center line as soon as I recognize that we're in some type of a range, because you'll notice that the price starts moving up and around and testing that center part over and over and over. And I found through my 20 plus years of being in the markets, of teaching and trading, that that is the area where the price is eventually going to move away from, and many times you can find early clues from that center area. So here are, we just looked at the patterns that were in the range. So here's a chart of ABCD patterns in an uptrend, in other patterns. So we have AB, here's a bull flag. So here's a bull flag that has an ABCD pattern. Here's an ABCD sell, but it's in a new uptrend. So we have some trader experience and a good trade plan. That might be something that the trader's trade plan says, no, we're in a new uptrend. I just traded a bull flag. I don't think I should be selling. So anyway, I work with traders, and my courses and things help you identify that type of thing. A, B, C, D down. Here we have the sideways money box consolidation, A, B, C, D buy pattern with that direction of the trend. This is what's called a dynamite triangle. And in just a couple of slides, I'm going to talk to you more in depth about this little pattern, and it is appropriately named. More ABCD buy patterns here. Here we have a kind of a wedge pattern here, and movement. Market takes a rest from the uptrend. So there's good examples of the same types of patterns in different market environments. For those of you that are not familiar with ABCD, I put in this slide for you so that if you want to take a screenshot of it, that's fine. It belongs to Trading Live Online, so please just acknowledge that. I love seeing my stuff out on YouTube, but usually only when I put it out. So anyway, here's the structure, basic structure of the pattern. And in the book Trade What You See, you'll learn all about it, or in the short course I'm going to show you at the end of this, you'll learn the complete pattern structure of this. Okay, now parallel trend channel is also a type of coil. And these form on all time frames. All of these things that I'm showing you are fractal, any time frame, 1 minute chart, 60-minute, daily, weekly, monthly. They're going to occur more often on the smallest time frames, of course. So notice that we have trends within these parallel channels. I mean, we have uptrends and we have downtrends. We have a sideways range, uptrend, downtrend. And that's just part of this process. Eventually, price is going to come out of this channel. Now, they can stay in these types of formations for a long time or a short period of time. But again, look at the center line here. Look at how the price keeps coming back to that center line and testing it. So again, important to identify where that center line is. Excuse me. So 1928 chart of GM. This is from my book, Jay Bacher's 1930 Stock Market Theory and Practice. Again, I said in the beginning, I trade things that are time tested. These are time tested, repetitive. You can build a trading plan. Trading plans don't have to be complicated things, but they should guide you in telling you, you know, what it is, what is your trigger, what's your setup, what's your stop loss, what are your exits. Most traders know how they get in, but getting out's really a whole different um, problem for them. And they tend to end up losing money because of that. So here we can see the sideways range that formed on this, and then the huge expansion out of out of this. And Shebacher said the chart formation indicating preparation for a major movement is the ascending bottom. These formations are quite suggestive of the triangle or coil movement. Remember, trends are born from coils. This is a chart of NBR. This is almost identical to what we just looked at from the 1938 chart of that ascending bottom as described by Shebacher. Now this, I'm sorry I did not update this. This was back in December. This actually was one that I had in my weekly newsletter, my video subscription, right? Do some different pattern setups and analysis for everybody. But now it's at 117. So definitely that has had an expansive move to the upside. Okay, now this is the fantastic pattern to learn. However, it can be a little tricky to really identify in real time because it can form, especially on small time frames, it can form and then explode out of there very, very quickly. But this pattern was identified by H.M. Gartley in his classic book from 1935, Profits in the Stock Market. Um, and he calls these small consolidations, triangles, dynamite because of the potential movement that they have out of this pattern. 3 to 4 times the amplitude of the pattern itself. So again, you have to, I'm going to show you some charts that have this pattern on it. And you'll see if we took the outlines of the pattern off, you can see how they might be a little difficult, or imagine how they might be a little bit difficult to see in real time because they form with only a few bars. So the definition of amplitude, just to give you an idea, and it just relates, you know, perfectly to this, is the maximum extent of a vibration or oscillation measured from the position of equilibrium. So our pattern is the position of equilibrium. And then, you know, all the markets are vibrations. There's just energy that's constantly moving up and down as the participants in the markets, that it's the energy that's moving prices up or down and determining the ripple effect of those movements. So Microsoft stayed in, here's, you know, a beautiful example of a coil and how a trend, and again, this, you know, it's way somewhere up here now, but this is a really perfect example, and look how long this coil was. That's what I'm saying. They can form over a short period or a very long period of time, but eventually they are going to come out of that coil. So this one started after the highs from 2000 and the decline, and then Microsoft stayed within this range until 2013, and then off to the races. Back in 2007, when I started my website, Trading Live Online, I had a live trading room up until about 2014, I think it was. And there was this A, B, C, D buy pattern right there on the center line. And that was identified as, you know, a buy opportunity in Microsoft. Of course, I'm thinking maybe not everybody held it to where it is today, but again, expecting a type of an explosive move. And once it came out of this range, see how important it is to mark your ranges in. I keep these lines on my charts like always. I only if I make a mistake and accidentally delete it or I lose a chart do I take them off. But you can see the retest with this little coiling, you know, process. It comes out and it's like, oh, look at this. Oh, I poked out of there. Do I like being up here? But this accumulation phase is where, a lot of big money was busy, 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 accumulating this, and then this explosive move out. The dynamite triangle right here, you can see this, only a couple of bars, and then another explosive move, retest, and off to the upside it goes. So another um, chart, this one, 1897 to 1926. I just really want to drive home to you. There is nothing new in the market. So, don't, well, I can't say don't, but I wouldn't suggest, you know, chasing yourself around trying to find the newest, latest thing when these are tried and true classic patterns that appear because of our human emotions that I don't believe we can get rid of, but we can learn to use them as assets. Um, and the markets will always do this. The only way they won't do it is if they completely close. So there's always going to be up, down, sideways movements. So here it took, what was this, 30-year period of up, down, but lots of different trends, within that 30-year period, but basically a big long sideways range. And then 1924 to 25, upside breakout, and then up into 1929 top. Now this chart I've left blank. We can see there is a downtrend with corrective pauses in it. So on the next chart, let's add some structure to it and see if we can identify the trading opportunities, or what the patterns are. Those are our trading opportunities by adding that structure. So this is the same chart. So let's start over here on the left. We can see here uptrending. We can see this range here, kind of a triangle, ascending triangle formation, more upside, and then the market forms a contraction phase. Usually tops are going to be a process like this. Bottoms tend to get more of a kind of a V spiky. There can be inverse head and shoulders and different patterns, but if it's going to reverse quickly, bottoms tend to do that more often than tops. Tops tend to go through processes like this. And then here's our center line. Here we can see the clustering around that center line price. And we can see here, look at this long bar off of that center line. Price test, we'll test back up. That gap is important and break to the downside. And then we have triangle type of continuation pattern. And now we have a little sideways range, a little money box range, more expansion to the downside. And then it takes a little bit longer pause. Let's see, this is all the way from December 2018 up to July. But we can see the downtrend is still, it's still intact here. This is about, I think, about a 0.618 retracement, Fibonacci retracement on that. And here we see there's lots of different patterns within this phase. It's like a parallel channel to the upside. Head and shoulder continuation pattern to the downside. Notice how it breaks the trend line, comes up and retests. So not all head and shoulder patterns have, exact horizontal necklines. They can be angled necklines. So this one is angled, and you can see the test back to the upside. Gap breaks that trend line, and more expansion to the downside. Then it goes back into the ranging. So remember what I said earlier, that the markets spend more time in the ranging and the contracting type of phases, but they cover more ground with the expansion phases. So I think this chart is a really good example of that. So now we come over here. So we've been in our range, and here this I mentioned earlier also that sometimes your ranges will change. So you mark in, okay, maybe what the start of the range was, which I had like here and here, but then I notice, oh, there's support in here too. So I'm going to draw another, another line in with that as the support line. And so that sort of gave me actually two center lines to work with, one from the range from here to here and one from here to here. So we can see, different patterns that were in here, A, B, C, D cell pattern. We had a bigger A, B, C, D cell. Here's a little butterfly cell pattern coinciding with that bigger one. Start to see some gaps, the gaps down through that center line, below that support. And then look at this big long bar coming for that low. There's a good indication that that's going to break at that time. And then we see a dynamite. Here's a dynamite triangle right here. And look at that expansion, the amplitude out of that point. So here's a really good chart. You guys can use that blank chart and then maybe this chart with it, maybe print both out. I used to do this all the time. I had so many charts printed out. I had my little triangle from the drugstore and my pencil or pen, and I would just draw on blank charts all of the time. I would just walk myself through from the left side and identify all the patterns that I could see. And you are really training your eye to be able to spot these things in real time. There's always a gap between what you learn in trading technical analysis and then you get to live charts that are moving. Um, and is a bit of a different story with that. So you have to learn to be able to identify things in real time. One of my programs I have is a self-study program from my website, and that has tons of material in it. And one of the sections in it is live trades. I sat for a year and waited for particular market conditions, such as all this stuff, and recorded it live so that traders could see how these patterns form in real time. So, as soon as I thought I saw an ABCD pattern, I would record it so you can see it unfold. And then I would talk about, how to trade it, how to enter it. What are your emotions? You're probably going to be feeling this. Here you see this price going up, but your pattern's telling you to sell it. So you constantly working with your emotions that way. And so my hope was to sort of shorten the gap between book learning and live trading. And I've always had good feedback on that course. So I hope that I accomplished some of that. So here's a chart with the current S&P 500 from, I think, just a day or so ago. It's filled in. It says 240-minute chart. I like to really vary my time frames. I like to sort of open up the top and look inside to see some of the detail of things. But here we can identify the ranges. This is going back to September of last year, pretty much since last March of 2020, the market is doing the same type of pattern. It's been doing an expansion to the upside and then going into these big ranges. You remember what I said about, sharp moves down, sharp moves up, sharp move down, sharp move up. So range, right? Here's the center line of the range, and you can see, how the price started to come up around through it, retest. Here's a little gap right up through it. It holds. That might be an early clue. Here's something interesting too, because not everything, all the examples in books are always picture perfect. We don't get picture perfect most of the time in real trading. So I want to show you some examples of that. So not all breakouts are just clean where they break out and just go. Sometimes they are going to jiggle around and do some more testing, and we can see that on here. So here we see the gap to the upside, it breaks out of the range and then comes back in. This is on the borderline of acceptable to come back in and test any further, and I would question that breakout. But then it comes back up, back above. This is where that breakout was, still testing, back below, but a little bit higher, and then back up, a little more consolidation, testing, and then breakout. And then look what it does, test. So these prices are doing this constantly, constant, constant, oh, do I like being here? Oh, I'm going to go test and see what I think about these prices down here. But in the meantime, that's still like a little range of itself, and then works its way higher back into another range. Same thing with our center line. This one sort of formed another range, came back in, really tested lower, and then kind of made another, you know, um, visible point on the chart where we could draw that resistance in as the upper resistance, and then eventually it broke out of that. Here's a nice A, B, C, D buy pattern leading up to that breakout. And so here we are now, currently on the S&P in a big range with the 4238 up here at the highs. FOMC meeting coming up. Starting to see some other things that are really saying this is winding up and it's getting ready for a larger move. One important thing to remember about any kind of a breakout is that they don't all succeed. They can be failures. They can either be a nice clean breakout and it just keeps going. It can break out, come back, and retest like we see down here. It can come back, fail, and come back to the center of the range, and now you just have a bigger range. Or it can break out, come all the way back down, and then out the other end. And those are usually going to be your strongest moves when that happened. And that can happen in reverse as well. It can break out to the downside, reverse, come back up, and then usually your strongest move is going to be from that type of price action. Okay, so now let's move on. Let's make sure I covered everything on here. Wanted to get. I think I did. If I missed something or you guys have a question on it, you have my email. Just email me a question on it. So here, this is the IWM, the iShares of Russell 2000 daily. So, from what we've talked about today, we have everything going on here that we've talked about, and this is ready for a breakout. We're getting usually this type of triangle formation, usually around 2/3 into the apex is about where you should see a breakout. Sometimes if it just keeps going and going, sometimes it just sort of peters out a little bit. So right around the 2/3 general rule of thumb. But look at all the patterns we can see. A, B, C, D sell, back down test, A, B, C, D buy, back up, A, B, C, D sell, and on it goes. So we tested that center area right now, little gap to the upside, and it's just sort of been holding up there. So there's something that you can keep an eye on. Bitcoin. Okay, let's talk about Bitcoin for a minute because when all my old books that I have, I can pretty much open any one of them, and instead of the word Bitcoin, you could just replace it with whatever the stock or market of the day was 100 years ago. And Bitcoin 100 years later is, the big thing that everybody's talking about. On May 25th, I presented for Stock Charts TV. I do regular segments for them on Your Daily Five. You can look it up on that date, May 25th, 2021. And the the bullish sentiment was so high that everybody was talking about Bitcoin coming back up to new highs. Elon Musk was buying, which I think I saw something back here about that. I thought, do you really seriously think that Elon Musk is going to tell you what he is doing at the time he's doing it? Do you think maybe Elon Musk had bought somewhere way back over here and now maybe Elon Musk is actually maybe selling some? That's usually more likely how it works. So be a little bit suspicious if you hear that much bullish sentiment on anything, and especially some well-known name associated with it. But let's walk through this pattern, because my segment that I did on this was titled "No New Highs Anytime Soon in Cryptocurrencies." So back here, beginning of the year, there were actually huge coils down at the bottom preceding this move up. I'm sorry, my chart didn't go that far, but I wanted to show you this section. Um, the patterns that were forming were predominantly bearish patterns coming up to these highs. We have what's called a 1, 2, 3 drive to the top pattern. This is the butterfly pattern. It's got the A, the B, the C, the D, and you have an extension above this previous high. That's your X point. This is a reversal, can be very bearish, and especially combined with, there was another butterfly pattern, X, A, B, C, D, extends above X, one butterfly pattern, two butterfly patterns. That's usually a signal. And then a decline started, and you have the buy the dip mentality, and then it's just totally declines. Here is a dynamite triangle right here that we've talked about, and the amplitude was 4 times the amplitude of this. If we sort of take this, let's see, about 1, about 2, about 3, about 4, even almost 5. So you can see how this is on a daily chart. But if you're on a short intraday time frame, this is going to form really quickly. So get really good at identifying these. Look at that long, bar to the downside on that, and then a very short consolidation. So again, there's still a lot of people thinking that this is, in my opinion, is not going to turn around anytime soon and make new highs. It's got to go now through a process. I think, go to the next chart. I had used the Grayscale Trust. That's a trust is a financial vehicle for traders to trade in Bitcoin. I had used this chart, but I think we're going to get closer down to this 127 extension before it gets a bounce. And I think it's going to be a bounce. It has to go through a process now, to get back up into new highs. And that might take quite a while. So here was the coiling process. Here was the trend to the upside. And then I just showed you the patterns on the Bitcoin chart. This one, A, B, C, D. This is a Gartley sell pattern because this one's contained within the X. And then here's the range, drop through the range. So you can see how that process of going from contraction, expansion, contraction is working. So here's a current. This is something that you can follow. Current range of Intel, and notice the time this formation started. We're all the way back in late 2017. And so 18, 19, 20, 21, we're 4 years into this coil. And here's our center line of this coil. Now, if we get like a poke up or a poke down and back up, then, this can get adjusted. But you can see the price really coming back to this price range right around that 55-ish, 56-ish area seems to be where it likes. So eventually this is going to break out of this range. It'll probably have a strong move, whichever direction it goes. But for now, you would use range trading tactics. Now, it's a little difficult sometimes when you're in the center of a range. That's usually not the best risk reward area. You kind of want to look for patterns that are a little bit closer to the extremes of the lows or the highs. You can control the risk better with that. And so here, this one I did not mark in any patterns with this. This is a chart of the corn futures. And I thought you could use this as a practice chart, and you can, again, you can print this out and you can walk through. Here's a Here's something we talked about down here, just as a hint, and identify based on what we've talked about today, these different phases and different patterns with it. So just as a quiz, I can't hear you guys, but as a quiz, where do you think, what phase you think corn might be in now? And then there is an ETF that the symbol is CORN that you can use as well if you don't look at the futures markets. Here's another example of ascending bottom. This is recent. CLNE is the symbol on this. This is an intraday 15-minute chart, and we can see the ascending bottom, and then we can see the expansion coming out of then. Again, look at the center line here, held that center line, came up to close, and then the next day a gap, very strong move. Here's an example of a breakout to the upside. That's a very clean breakout on that. And now I wanted to show you an example on this Apple chart of the concepts that we've talked about using this chart and looking at the butterfly cell and some Fibonacci retracements. So here the market formed this big butterfly cell pattern. Here's a smaller butterfly cell pattern, both of these coinciding together here. And the market was pretty bullish on Apple. I'd heard a lot of people, technical analysis, giving estimates that Apple was going to go, like from here, this little retracement here, and then continue up to 200 and something dollars. I don't, maybe someday it'll get there, but for me, I was looking at a big butterfly pattern, thinking, in my analysis, I don't think so. So now we've had an AB CD cell pattern, and we're down. This is about the center line of this whole pattern here. These retracements, you're looking at the low to the high. And if we break, these lows down here, these lows, we're probably going to see Apple get down to an extension of this pattern, probably around the 5.0. It's coinciding with some gap areas there, maybe even down to about the 6.1, 6.18. So right now, though, it's in the range. You can almost mark in a second range using like this low, extending it across here. So I think if it breaks this low, we're going to see some more move to the downside now. So that's all the charts that I have for you today. So I'll just take a couple of minutes now. If you're interested in this type of thing, I put together, this is a 3-hour and 30-minute video course on the history of Fibonacci ratios. And I'm going to show you about the introduction to harmonics and repetitive swings. These are really important things to recognize when we're looking at these patterns. You may have already noticed it, that the lengths of the swings tend to repeat, especially when you're in the range trading environments. And understanding these can be extremely helpful in putting together your trading plan. It's going to help you with entry points, and especially with designing your exit strategy. But these repetitions, these are going to show up on all markets, all time frames. So I think you'll find that really interesting. And then this is going to give you to learn the correct structure of the ABCD and the Gartley 222 trading patterns. Um, I hear a lot now. H.M. Gartley from 1935. He did not name this pattern. A lot of people out there that have sort of learned a basic structure, maybe not quite the correct structure, but a basic structure, give credit to H.M. Gartley, and that's not where this pattern came from. Larry Pesavento named the Gartley 222 pattern. And if you go to page 222 of H.M. Gartley's book from 1935, and you're trying to find something that says Gartley pattern, you're not going to find it. What he did was he described a corrective type of pattern. And Larry Pesavento took the structure of what he was describing, and then he applied Fibonacci ratios to help us with the structure of it. So just a little bit of history for that. But there are really some important structural things with this pattern and also with some of the extensions with this pattern. Once you have this pattern down, then the Gartley pattern, the butterfly pattern, the three drives pattern are all going to fall into place. But this one is the most important to learn the really solid structure of it. And then I'm also going to show you the powerful butterfly reversal. We looked at some of the examples of that. It does not always get an enormous move, but it has the potential to do it. And you combine that with your knowledge of ranges versus trends and where you are in that structure in the market phase. And you start to see, like we looked at on the Bitcoin chart, you start to see these types of patterns show up, and that can give you a real edge in the markets. And then I also included 3 ways to use the 3 drive pattern. We looked at a 3 drive also on Bitcoin, but it's not a pattern that is discussed often in technical analysis. But again, it's a very good pattern to learn, and it can either be signaling pauses in a trend or sometimes reversals in price as well. So the special, I usually have this on my website for $99 for 3 hours and 30 minutes. That's a lot of information. You also get a PDF copy of Essentials of Trading. It's not what you think, it's how you think. And this book was meant to be inspirational. Again, you have to really know yourself in trading in order to have longevity in the markets. And so a lot of these articles are about our own Larry Pesavento and my own experiences with that. So the special is $79 for all of this until June 15th, and then it's going to go back to $99 on the website. And again, here's my email. And it was my pleasure today to bring you this information. I hope you found some worthwhile pieces of information, and I'd love to hear from you. So I wish everybody best wishes for successful trading.